All right, let's get right into it. Welcome to this explainer. If you've been feeling like SaaS growth is suddenly like wading through molasses, trust me, you are not alone. We're looking at some massive macroeconomic and tech shifts today that are creating a frankly brutal landscape for inefficient companies as we march into 2026. We're going to break down exactly why growth is stalling and, more importantly, how the absolute best companies are adapting to survive it.
Let's kick things off with a pretty staggering number. 65% down to 28%. That's the median growth decline for software companies in just a single year. Industry insiders call this the dreaded growth decay curve. Look, companies usually don't just hit a brick wall all at once. It's more like they bleed momentum over time. So we really need to understand what's triggering this massive deceleration before we can even think about fixing it.
Section 1. The End of Hypergrowth, the 2026 Reality Check.
Remember back in 2021? Cheap capital basically made growth the only metric anyone cared about. Investors were totally fine with crazy burn multiples and payback periods stretching out for years. Well, that era, it's officially dead. Today, higher interest rates and a much tighter market mean capital efficiency and sustainable unit economics are what actually dictate who gets funded and who survives. The rules of the game have entirely flipped.
So here's your 2026 reality check. If you're in that $1 to $30 million ARR range and growing at 26%, you might feel like you're crushing it. But honestly, you're just coasting with the median. The actual top performers in that bracket are hitting 40 to 50%. Meanwhile, public SaaS markets have kind of settled around 17 to 18%. The big takeaway here? Sustainable, highly efficient growth is valued exponentially more than hypergrowth that's built on terrible unit economics.
Moving on to Section 2, Vital Signs Failing, Diagnosing the Silent Killers.
This one hurts. $2. The median SaaS company right now is spending $2 whole to acquire just $1 single of new ARR. That cost has skyrocketed up to 60% since just 2023, and it's because of rising ad costs, insanely complex buying committees, and sales cycles that just drag on forever. Hunting for new logos has gotten ridiculously expensive.
And when it costs you that much to get a customer through the door, churn becomes the ultimate silent killer. Average B2B SaaS monthly churn is sitting right around 3.5%. If you're bleeding customers at that rate, or worse, it's a giant red flag. It means there are critical failures in your product market fit or your onboarding. You literally cannot outsell a leaky bucket when acquisition is costing you 2 for 1.
To make matters even more complicated, the actual way we charge for software is working against us. Traditional per-seat pricing, it's collapsing. It only makes up about 15% of the SaaS market now. Why? Because charging per seat is basically a tax on your customer's growth. If a CFO realizes they're paying for 200 seats but only 40 people are actually logging in, you better believe that contract is getting slashed. That's exactly why usage-based or outcome-based pricing has rapidly taken over, making up 51% of public SaaS companies today.
All right, Section 3. The AI Existential Threat, Beyond the Seat License.
Now, this breaks the AI threat down into 3 distinct horizons. First, the cyclical risk happening literally right now, seat compression. As AI makes individual workers faster, companies just need fewer human seats. That attacks the legacy pricing model we just talked about. Then there's the secular risk over the next 1 to 5 years, agentic AI. These AI agents are going to migrate business logic completely out of the traditional SaaS layer. And finally, the super secular risk beyond 5 years, total architecture commoditization. That's where AI agents become the primary users of enterprise software, not us humans. It's a massive structural shift that demands totally reinventing how we build software.
Section 4. The 2026 Survival Playbook. Retention over acquisition.
Okay, despite all these terrifying hurdles, about 18% of startups actually manage to maintain or even improve their growth. How are they doing it? Well, they realize that growth for growth's sake is dead. The companies commanding those premium valuations today, the ones actually getting funded, are growing efficiently. They've got improving retention, solid gross margins, and a very clear path to actual profitability.
Which brings us to the Holy Grail. If there is one single metric you need to obsess over for 2026, it's NRR, Net Revenue Retention. This measures how much revenue you retain and expand from your existing customer base. Look, in a world where new customers cost an arm and a leg, expansion revenue is the absolute cheapest growth you can get. It's your ultimate lever for capital efficiency.
I absolutely love this analogy. Think of your annual recurring revenue, your ARR, as your heartbeat.
It keeps the business alive day to day. But your NRR? That's your cardiovascular fitness. It determines how fast and how far you can run. The data completely backs this up. Companies with an NRR over 100% grow up to 3 times faster than their peers who are stuck constantly hunting for new logos just to replace the ones they lost.
But it's time for a bit of a brutal truth drop here. You can't just upsell your way out of a bad core product. If your gross revenue retention, meaning your retention before you even count those upsells, is sitting below 80%, then any expansion revenue is basically just putting a Band-Aid on a gunshot wound. You absolutely have to fix your base retention, smooth out your onboarding, and plug those underlying leaks before you even think about selling more to your existing base.
When you look at this benchmark table, the profile of a winning company in 2026 becomes mathematically crystal clear. The winners, they keep their customer acquisition cost payback under 12 to 15 months. They maintain gross margins above 75%. And they rigorously balance growth and profitability against the rule of 40, making sure their growth rate plus their profit margin equals at least 40%. That right there is the blueprint of a healthy SaaS business today.
So, let's tie all of this together. Your playbook to combat the growth decay curve really comes down to 4 key steps. Step 1, plug the leaky buckets and target a monthly churn of under 1%. Step 2, cultivate that NRR to push past 110% through smart cross-selling. Step 3, shift your pricing. Get away from those per-seat taxes and adopt usage-based models that actually align with the value your customer gets. And Step 4, drive capital efficiency by relentlessly optimizing unit economics to get that CAC payback under 12 months.
I want to leave you with this provocative thought as we wrap up this explainer. Look at your metrics, look at your pricing, look at your retention. Honestly ask yourself, is your business designed for the cheap capital and hypergrowth of 2021? Or is it structurally built, hardened, and optimized to survive and dominate the realities of 2026? It's time to take a hard look at your capital efficiency and make those tough pivots. Thanks so much for joining me on this deep dive.